Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas, the co host alongside Stephen Thomas, chief economist and founder of Reports on Housing. Today, we have some fun topics to go over. We have some recent economic news, if there are any, and statistics on real estate. There's stuff happening there. Update on the government shutdown. Signs of the market is healing. A little game called Guess That Market. It's going to be brand new. It's going to be so much fun and more, of course. But Stephen, first, how are you doing?
Great. We're kids are running. Flag football season's over, and Zeke's playing soccer, and it's just and Halloween's in a week, so got some Halloween parties and neighborhood shindigs coming up this weekend. That should be a lot of fun. And the Ducks are surprisingly not laying a giant egg right now, and I don't want to jinx anything, so we won't talk too much about it. But we like the Ducks, so I like how they eked out a win last night. What was it, like 7-5?
It's like scratching my eyeballs watching that.
Seriously, that's like the second gigantic score. Our goalie's a little porous, but doesn't matter if you keep on putting the puck on the other end more times than the puck's being placed in your end, and that's kind of what's going on right now. How about you? What's going on with Brennan Joseph?
Yeah, same old here. Just training for the marathon still, going well. Lots of running. I am starting to feel like I'm getting to that point where it's not as burdensome to go for a run, where before I felt like I was barely able to breathe. But outside of that, everything's going well. I'm not going to speak on sports because, like you said, I don't want to jinx it. So I'm just happy with what I'm seeing. I'm content. So I'm just going to leave it at that. But Stephen, how long has it been since the government shutdown initially occurred, and what have been the implications at this stage? It is October 24th as we're recording. So
Yeah, well, the government shutdown started midnight, September 30th. So here we are, October, all the month. So we're at 24 days, and it's going to go to 31 days next week, and it's going to go on forever, it seems. So this will be the longest government shutdown of all time. Then it definitely has the feeling of it. Doesn't feel like anybody wants to cares to reach across the aisle and figure things out between the two parties. So I'm not big into politics. I'm into, okay, now what's the implications in the housing market? So and this one is bigger than even the last one because there were carve outs for the last one. This one is a full on government shutdown. Everything is shut down completely.
and how does the Federal Reserve behave during this time? What do they do without all this data that they are missing?
Well, we got CPI today, and that was actually a little bit less than expectations. And I thought because it was a little bit less than expectations that we might get, it was the only data report we've received from the government so far since the government shutdown. So we're missing a ton. We got the one report, and it was less than expectations, and interest rates didn't do anything at all. As a matter of fact, they went up, 0.01%, which was pretty much nothing. And I thought that there should be a little bit of improvement, but there wasn't. And so we wait now until this government shutdown ends so we can finally get some statistics that everybody cares the most about, and those are labor statistics. And right now it's like operating in the dark. There's going to be a quarter point rate cut this coming up week, and it's telegraphed pretty much. The market's already expecting it. If you're out there listening to this and it's Wednesday and this is when they meet, and this is when we're going to drop it before they even talk, I want you to know the following, that mortgage rates won't drop 0.25% because they're cutting 0.25%. They're cutting a short-term federal funds rate. It is an overnight banking rate. You need to understand, that's an overnight banking rate. That's short-term. Mortgages are 30-year mortgages. They're long-term. So as a matter of fact, it's today's interest rates already have it banked in that they're going to do a quarter point rate cut. As a matter of fact, they already have it banked in that there's most likely a quarter point rate cut in December as well. It's just we need more data to see if there's more cracks, to see if there might be a half a point rate cut in December. But if they don't open up the government, we're not going to get any of that. So right now it's just status quo. As far as rates are concerned, they're moving sideways. They're not really doing much at all because we don't have a lot of data. They're going to do their rate cut. I can't wait wait to hear what they have to say about everything that's going on and being dataless, because we get excited. We wake up at 5:30 in the morning and there's a new data point. But right now, we've already missed one jobs report. We're most likely going to miss an additional jobs report coming up that should have come out in a couple weeks. And we're missing every single initial unemployment claim report that comes out every single Thursday. And missing all that stuff. So we're missing a lot right now. And so are they. And they don't have a lot to operate with. And they're going outside some public sources. But even some of their public sources, I don't know if you've been listening, but ADP said, oh, you can no longer have it. I don't even know why. It made no sense. But that's what basically was said. But ADP is a private payroll company, and they have a lot of payrolls they take care of, but it's only a tiny fraction compared to what they're typically used to getting. And that's why when the ADP releases their information, it really doesn't move the markets at all. This coming up one, though, might move it because it'll be 2 months since the last time we heard anything about labor.
Well, on the flip side, I want to talk about something a little bit more positive now. For so many years, I mean, I can't even recall how many we've heard things about housing crash. We had COVID, we had all these different things manipulating the market, making the market evolve. We saw supply fall to crazy low levels. Demand is shrunken, and now it's just at these really low levels year over year. And I wanted to ask you, what are some signs that the real estate market is actually healing instead of the negative news that we are used to seeing? What are the positives that we can turn to?
Their mortgage rates remaining below 6.5% with duration. Last year we hit 47 days, and really what that was below 6.5%. It fell all the way down to 6.11% the week before the Fed met in September and the day before. But getting there, it was like there's this giant drop that got us down really low. And then after the Fed met in September, by the time we got to the end of or the start of October, it had risen, and we got into October and we got all the way back up to 7%. So it looked like what I refer to as a toilet bowl. It's just this big drop. Then it was down low for 47 days, and then it climbed right back up. That's not what we're experiencing this time. This has been a slow deceleration because of the sluggishness of the economy that we're seeing, especially on the labor side of things, from about June until now, that we've seen this methodical drop, and until actually the start of September. And then we've been going sideways since September. And the reason for that is because the government shut down, nothing else that we've been able to receive. So rather than it continuing to go down a little bit more, if something were to further break, we don't know. Everything's just been going sideways. But the good news is we're below 6.5%, and we're recording this on October 24th, and we're at what, 51 days? So we're 51 days, beats 47. I think they're here to stay below 6.5. I think they're here for the rest of the year. And I think we're starting off 2026 with less than 6.5%. Our base case for our forecast is between 6 and 6.5 for 2026. And it's not even, our forecast is not totally locked in. We keep doing these forecasts, but there's like a little bit of an evolution because there will be more data that comes in that will make it more crystal clear right before we get to 2026. But then we'll be able to carve out where we really feel we're going to go. But this is where the base case is right now for where we're going next year. And then by the time we write the reports for all the different markets, that is the very, very end of the year. And we have a fairly good idea about where we're going to go. And it really depends upon mortgage rates. And I have been praying constantly every day, and especially on Sundays, I'm getting down on my knees because I'm a spiritual guy. I'm actually praying for 6% rates. I'm not even praying for 5.9999. I hear it in all my meetings that I do, because I want millennials and Gen Zs to be able to enter the housing market without having to compete against each other. And if we dive down to like 5.75%, all of a sudden it would create a really crazy market for the spring of 2026. So I'm not interested in that. Just 6%, and we're making our way there. We're almost there. It's just lack of data is preventing us from going down any further from where we're at right now.
So you talked about mortgage rates. Have you seen any large improvements with the real estate industry as a whole? Supply, demand, speed of the market, pricing?
Yes. So, and Zillow just did they recalibrated. It actually was released, I believe, today, and it's for year over where they think it's going to go from this year to next year, and they're positive for the country up like I think it's 1.2%, and even areas like that have been slightly negative are to go positive like, along here in where we're at in. I know Clark County, Vegas, as well as Phoenix, Maricopa, as well as Southern California, which was slightly negative. It's going to be slightly positive, like 1.7% or something like that. But still, nonetheless, positive for the year. That's kind of a change, and the reason for that change is because of the lower rates, and that's where they're expected to be. That we're going to get a increase in we're going to get more homes that come on the market because we've been getting more and more every year. Still not enough compared to where we were prior to the pandemic, but we're going to get more pending sales activity, which translates to more closed sales. And that's coming. It's just that right now we're getting this very favorable mortgage rate environment, and we're almost done with October. We're about to enter the holiday market, which is the mid-November, and that's where everything slows down. Everybody likes to go enjoy the holidays. Fewest number of homes come to the market in December, second fewest in November, and then very, very few pending sales in the month of December and not a lot in November either. So to close out the year, it starts to really slow down. So we're getting these great rates that match up with the slowest time of the year. But what this is teeing up is for a very, very good start to 2026, like I said. So there's a big silver lining behind where we're at right now and where we're projected to start the coming new year.
So you talked about mortgage rates being at 6.19%, which is a great level. If they continue to head to lower levels like they have been pretty much this whole year, as they've, yeah, like I said, been trending that direction, what sort of impact could there be? Without going into too much detail, because I know this is your pretty much your forecast, but what sort of positives would there be, generally speaking?
Yeah, so it's just finally we're getting to the level where home affordability really improved. If you look year over year, I mean, we were above 7% right now. And it being above 7% and starting off 2020, the ending 2024 and the starting off 2025 above 7% just was not a good lead into the spring of this year. And so at 6.19%, that is a whole percentage point less. And you have to imagine that people are saying, well, that's still above where rates were before. It is such a better rate that it actually unlocks a lot of homeowners from being able to sell their houses, as well as then they turn around and they buy something, as well as there's just more movement. And when there's more movement, it allows millennials and Gen Zs to come in because it's more affordable. And now you've got more churn, and more churn means that we have more pending sales, more closed sales. And that's actually a benefit to the overall economy. Every time something sells, it's not just the real estate industry that makes money when somebody sells. It is all the tradespeople that go into fixing up houses. When people go in, they buy new furniture, they do a whole bunch of things that actually stimulate the economy. And that has been a big missing piece so far. So as the economy is starting to slow, this is where real estate can come in and kind of like save the day type of thing. So we'll stay tuned for that.
Sellers in the US housing market currently outnumber buyers by about 500,000, according to the latest Redfin data. I feel like I quote them a lot, but that's okay. The biggest gap on record since the real estate brokerage started collecting data in 2013. Is this a figure that the US should be concerned about? Or is this something that we need, as you like to say now, proper context?
Yeah, so across the country, they're saying that the gap's pretty big, and it depends upon the marketplace too. You have to really know real estate is local A. They're also starting in 2013, which was the beginning of the expansion of real estate. 2013 was a really strong year. So what they're not comparing it to is where they didn't start data, and that was prior to 2013. we had the Great Recession. Now that would have been a insurmountable gap because there were 4 million homes on the market versus what there was it got all the way to 4 million, and then by the time we got to 2013, it had come down, and now we're playing right around 2.5 million versus 4 million. That is a big difference, and that's where we would peak out for the year at 2.5 versus 4 million where we were during the Great Recession even prior. So that gap where buyers were and where the number of homes were on the market had to have been the biggest gap when they weren't really keeping track of all that. So although that sounds like doomish, at the end of the day, it just says that, yes, it's a little bit more sluggish than what people have been experiencing. But you have to remember, not every market is the same, because we actually have done markets going all the way back to 2004. And I could tell you, this is not the most sluggish by far compared to when you saw the Great Recession, it was it was unreal. And it was the unreal starting in the fall of 2005, and 2006 was just extremely sluggish, nothing like what we're experiencing today. And then trickle in all the extra homes that they're talking about. A lot of these homeowners don't really have to sell. There's not that missing piece is the people that have to sell. They must sell. And that doesn't exist today. And the must sell, have to sell that existed back then were foreclosures and short sales, where it got to a point where they were 2/3 of all activity, all pending sales and closed sales. Man, I kid about it, but there were sign writers that went on the for sale signs, and I actually show this during my presentations right now. Back during the Great Recession, people would say not a REO, not a short sale. And why did they say that? Because you'd go down and drive down a street, and every home would be a foreclosure or a short sale, except for this one. And how do you differentiate it? You said, I'm not a foreclosure or a short sale. You can come here. That's what is missing in this data. So it's missing a key piece.
Just as a quick reminder, what are your 3 signs that home prices are crashing?
Yes, you added this right now, and I love that. So there are three signs, and you have to have all 3 in order to have prices plunge. And I'll go toe to toe with anybody on this all day long. And that is, number one, you have to have a lot of inventory, a glut. We don't have enough. We're at 1,550,000 homes across the United States versus 4 million, like I said, prior to the Great Recession that led up, that we saw it in September of 1995. 2005. 2005. And that's how long I've been doing it. That's how old my brain is. And then, but 2006, 07, 08, it was really out of sorts. So you can't really compare the two at all. But so there's very little supply. We have a supply crisis still, even though we've increased over the last couple of years. It's still very limited, and haven't even got to where we were prior to the pandemic, where it was still limited compared to where we were during the Great Recession. So don't have enough supply, and we don't have enough foreclosures and short sales. That's the second item. So 2 items that are missing, and we won't get those. We did a YouTube video on that with a housing debrief where we unveil that, and we've actually written reports about it. It's just not going to happen. National delinquency rate is too low. It won't materialize. I don't care what people say, or if there's more FHA. We've done things on that too. It's just we've pulled the onion apart many different times. So we don't have enough inventory. We won't have all the distressed. Those are 2 giant items. The only one of the 3 items that are there is the low demand. We have very, very low demand. We've had it for 3 years straight, yet it hasn't resulted in crashing prices. And the reason it hasn't is because we're missing the glut of inventory and the foreclosures and short sales. You have to have all 3.
Well, thank you. As a podcast enthusiast, from economics to sports, I want to try something new today. So we are always evolving, just like real estate. And I want to add a little guessing game called Guess That Market. And this is for Steven, this is for you. And then same as for you guys who are listening here. You can join along. You can try to guess whatever market I'm referring to. That's totally okay. So here's how it works. I will throw out a few quick stats like expected market time, speed of the market, or sold to list price ratio, anything like that, all pulled from real housing data. So you guys can drop it in the comments. You can just write it down somewhere, or you can just think about it. I wonder what he's talking about. So it could be a city, a county, or even a surprise region. And of course, we will talk through what the numbers mean once Steve locks in his answer. So here are your 2 clues. And this is sort of not a difficult one. I said I'd go easy on you today. For this market, the sold to list price ratio is 98.58%, and it has a speed of the market of 114 days. And it could be a county, it could be a city, it can be an area.
Well, because you're going easy on me, it has to be a county.
Maybe.
Well, do I get to ask you a question? Yes or no? It's a county. Yes.
Yes. All right, there you go.
And then I'm thinking it's either San Bernardino or Riverside because they're right neck and neck, right around the same.
You got to lock in your answer.
Well, you said 114. I'm going to lock in Riverside County. That's what I'm locking in.
All right. That's a good guess. Right next to it, Los Angeles County. So 114 days expected market time. Obviously, that's slower than previous years. 98.58 sold to list price ratio. What do these figures mean? What sort of market are we seeing in LA?
Yeah, with LA, it's changing there too, because right now they've been. It has to do with the amount of inventory and demand and where it's at. What's happened is the last several years is we've actually had very, very similar demand. The only time that it changed was last year, the 47 days that we were below 6.5%, and right now the 51 days below 6.5%. So that's why we're getting a bump up this year, just like we did last year, and year over year, it's very, very similar. So it's actually the overall market is improving in Los Angeles County. And, because it was a little bit more, hey, they've been pretty stable. We've seen a lot more markets that have actually improved more than Los Angeles County. They've kind of stayed. They've been bouncing around between 120 on down towards 114, but it's pretty much stayed right around there. And the reason for that is it doesn't continue to slow down. That's the thing. From spring to here, it slowed down. Then it looked like it was going to continue to keep on rising, but it didn't. And that's because of the improvement in rates. Now, there's still a lot of homes out there. And what has been transpiring are more of those homes have been slowly but surely been coming down at a similar rate as demand has been coming down. What was happening earlier in the year is inventory was going up and demand had kind of like peaked and was flat. And if you have more and more inventory coming on and coming on and coming on, the overall market time slowed quite a bit. And so if you peeked into the rearview mirror and you looked at what happened back in May, we had or back during the spring, we had expected market time that was less than 100 days, and it has grown from in the 90s all the way up to where it is today at 114 days. But it stays where it's at right now. There could be further improvements. We just need to drill down to 6%. And it's lining up during the slowest time of the year. Now, what this will do is we're not continuing to slow down. And as we go through the rest of the year, we'll get the demand that comes down, but we'll get the inventory that comes down at a fast pace too. And we're going to get a number of people that delist their homes, pull their homes off the market. And very few homes come on the market in December, second fewest in November. And so what that does is we watch the inventory levels come down. But at the same time, we're finishing out the year. We're in the holidays, less pending sales activity. So values have been coming down because there's been more inventory than the last couple of years in Los Angeles County. There are, right now, where are we at as far as inventory is concerned? Can't really remember.
14,000.
14,000 homes on the market. And that it's already peaked out and it's going to be coming down from there. And it's just this is the lining up towards the end of the year. Now you have extra homes than we did last year, and we had way more homes than we did 2 years, and demand is not that much change. So a couple of years ago, we had values going up in Los Angeles. Last year, it was kind of a little bit positive, and then this year, it's turning out to be right now. There is the pendulum sweeten. It's that scale is tipping a little bit in favor of buyers. So you get the people that want to sell, that's still that they're okay. I'll take a few $1,000s off. We have prices coming down slightly in Los Angeles, but that can change on the drop of a hat, and that's what I expect for 2026 with these rates starting off below 6.5%. It's going to be a lot speedier than what people expect. So value is coming down just slightly. A few $1,000s off the last comparable sell. That's not really much to write home about. Not going to have a plunging prices because the inventory levels have to get to not 14,000. They have to get to like 35,000. They have to get like double where they are at least, and then have this demand really low, and then sprinkle in some foreclosures and short sales, and now you got the recipe for values coming down. That's not what we have in Los Angeles. So thank you for that. I was close. Because I
You were
the
close.
problem was the sales to list price ratio, because which San Bernardino would be, I think theirs is a little bit higher, and I can't remember Riverside off the top of my head, but they're all like right at 114 day expect.
Yeah, that's right. It's all about the same level. So that was designed to trick
Speed
you
in
a
the
little
market
bit.
threw me off because they're all very, very similar.
Well, that means the game was successful. So there we go. All right. Well, now back to the fun. Bank of America says there's worries of a recession again, of course, has fallen to the lowest point since February 2022. UBS, on the other hand, says there's a 93% chance of this happening, an actual recession occurring again. So, Steve, to finish off today's episode, what is your economic outlook for a recession? Is that something that you're seeing? I know you talked about your recession flags, and I know this has been talked about time and time again. But since these sort of things, I saw it trending the other day, I was like, where did this come from? What is your actual outlook for this?
Yeah, it's funny because then after, I think that came from a release on September 1st. So what a delay. Holy cow. And then when X gets a hold of it, that's it. Recession's coming. And because they said it. Because one person said it, now we're going to quote it. That's just not how it works. They are going to be wrong. I don't know of that many economists across the United States that really called for recession. It's just not right now in the tea leaves, and looking at all the tea leaves. Their recession model is missing some key features. And there could be some real false positives right now, which we already learned because a lot of people, their recession flags were blowing. Ours never blew all the way because we're missing that break in labor. That we really haven't had the break in labor. It doesn't have to be a big break in labor, but you need a lot more unemployment to drive a recession. And we're not talking a lot of unemployment because that's not, if a recession were to come, that's not the kind that we would get. But we're not even there yet where there's a flag that goes up. And you'd see that one of the biggest indicators, there's a big section of the economy. It is the residential side of things, the residential building, and that has not cracked. And usually when that cracks, that's usually when you could see some cracks in the rest of the in the rest of the economy. And we're not really seeing that. What we're seeing is that there are firms and the companies across the United States are not hiring that many new people, but they're not firing either. So that's why we're not getting this break yet, as far as we know. Because I just, you read these different things and all of a sudden, oh my gosh, everybody's being fired. I think there was something like 6,000 jobs that were being lost for Apple's getting rid of an AI unit or something like that I read the other day. So, I mean, there's different things like that where you go, oh, here it is. But that's just, and people bring that stuff all up all the time. I remember when there was a lot of layoffs on the internet side of things up in the Silicon Valley a couple of years back, and people are going, that's it, this is the beginning of it. And it's just there aren't that many of those employees across the United States that it didn't really make a difference. So you have to be careful what you read, be careful what you hear. You have to look at the overall picture of what they're talking about, how big of a piece of what they're talking about, and then you have to look at it back in time. And so we look at a lot of different areas of the economy, and we just don't see it. So it's right now. It just doesn't show. And you can hear it, you can try to listen to economists saying that there's going to be a recession, and you really are going to have to strain your hearing a little bit because you're just not going to hear anybody saying it. This was just one of those that talked about it, and of course it blew up because they're the only ones talking about it. And usually there's a lot more science where a lot more economists are going to say, yep, that's what we believe in, but that's not what we believe in. We need to see more definitive proof that something like a downturn of the size that they're talking about, where you have negative GDP for 2 straight quarters, just don't see it right now.
All right. Well, you heard it here. Low chance, but still possible. Thank you, everyone, for tuning into another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate industry or the economy, you can subscribe to our housing reports. And that's done via our website, www.reportsonhousing.com. Very easy to find. Or go check out our YouTube. We have a bunch of good stuff there. Just did a video on, the silver tsunami, talking about boomers. We got stuff for sellers, buyers, housing crash, whatever you want to go find. There's information there. So go check it out. We will see you very soon, and have a fantastic rest of your day. Thank you.
Thank you.